During the early 20th century, the global economy operated under a framework where currencies were tied to gold reserves, a system that had evolved from centuries of monetary practices rooted in precious metals. This gold standard ensured that paper money represented a claim on physical gold, promoting stability but also imposing rigid limits on economic expansion. In the United States, this arrangement faced its ultimate test amid the catastrophic downturn known as the Great Depression, which began with the stock market crash of 1929 and deepened through a cascade of failures in industry, agriculture, and finance. By the time Franklin D. Roosevelt assumed the presidency in March 1933, the nation grappled with unemployment rates exceeding 25%, widespread farm foreclosures, and a banking crisis that eroded public trust. Families across rural heartlands and urban centers alike saw their livelihoods evaporate, as idle factories symbolized the broader paralysis gripping the economy. The roots of this turmoil traced back to the post-World War I era, when speculative booms in credit and investment created vulnerabilities that the gold-backed dollar could not easily accommodate. As panic spread, depositors flocked to banks demanding conversions of their savings into gold, accelerating a vicious cycle of reserve depletion. This pressure exposed the gold standard's inflexibility. With currency issuance capped by available metal, authorities struggled to inject liquidity and halt the deflationary spiral. Roosevelt, inheriting this chaos, prioritized restoring confidence through sweeping reforms. Among his initial measures was a series of executive actions aimed at centralizing control over monetary resources. On April 5, 1933, Executive Order 6102 marked a pivotal shift, prohibiting private ownership of gold coins, bullion, and certificates beyond minimal exemptions for industrial or artistic uses. Citizens were required to deliver their holdings to Federal Reserve banks or authorized institutions by the month's end, receiving compensation at the prevailing rate of $20.67 per ounce. This directive stemmed from the administration's assessment that widespread hoarding was exacerbating bank instability and constraining efforts to broaden the money supply. In the broader historical context, such interventions echoed earlier government responses to crises, like those during the Civil War, but this one represented an unprecedented intrusion into personal assets during peacetime. Compliance varied, reflecting the diverse human experiences of the era. Many individuals, from immigrant laborers who had amassed small caches as a hedge against uncertainty, to middle-class families preserving generational savings, queued at banks to exchange their gold for fiat currency. Others, driven by skepticism or desperation, sought clandestine means to retain it, concealing bars in home safes, interring them in remote plots, or repurposing them into permissible forms like dental fillings. The penalties for defiance were steep. Fines up to $10,000, comparable to several $100,000 in contemporary terms, and imprisonment for as long as a decade. These measures not only compelled participation, but also underscored the government's expanding role in economic affairs, setting the stage for long-term transformations in fiscal policy. Following the collection, the Gold Reserve Act of January 1934 redefined the official price of gold at $35 per ounce, effectively diminishing the dollar's value by about 40%. This adjustment allowed the Treasury to realize substantial gains on the accumulated reserves, channeling funds toward deficit spending and infrastructure initiatives under the New Deal. Cause and effect intertwined here. The influx of gold bolstered Federal Reserve holdings, enabling credit expansion that revived lending and stimulated recovery in sectors like manufacturing and public works. Yet this came at the expense of those who had surrendered their assets at the lower valuation, illustrating how policy decisions could redistribute wealth from private hands to public coffers. Legal challenges soon emerged, highlighting tensions between individual rights and state authority. Contracts from the pre-depression years often included gold clauses, stipulating repayments in gold-equivalent terms to safeguard against currency fluctuations. The government's actions nullified these provisions, prompting suits that ascended to the Supreme Court in 1935. In a closely divided decision, the justices affirmed the executive's powers, reasoning that emergency conditions justified overriding private agreements for the collective welfare. This ruling established an enduring precedent, affirming governmental latitude in monetary matters during crises and influencing subsequent interpretations of economic regulation. From a long-term perspective, these events dismantled the classical gold standard, transitioning the US toward a managed currency system where dollars derived value from legal tender status rather than redeemability in metal. This evolution facilitated greater flexibility in responding to future downturns, but also introduced risks of inflation and diminished purchasing power. For the banking sector, the consolidation of gold reserves restored solvency, preventing further collapses and fostering a more centralized financial architecture. Government entities gained enhanced capacity for intervention, funding expansive programs that reshaped social safety nets and labor relations. Human stories abound in this chapter of history, revealing the personal toll. Consider a Midwestern farmer, perhaps, who had bartered labor for gold coins during prosperous times, only to see them requisitioned amid mounting debts and crop failures. Or urban workers in cities like Chicago, exchanging family keepsakes for notes that soon bought less bread and fuel. Such narratives humanize the statistics, showing how policies intended for macroeconomic stability often disproportionately burden the vulnerable, widening disparities between everyday savers and those with access to exemptions or offshore strategies. Beneficiaries included not only the state, which amplified its reserves by billions in adjusted value, but also financial institutions that regained public faith through guaranteed backing. Elites with foresight relocated holdings abroad or invested in unaffected assets, such as rare numismatic items, perpetuating inequalities. Conversely, the primary casualties were the masses who viewed gold as a timeless safeguard, only to witness its forcible conversion into depreciating paper, eroding their economic security. Reflecting on subsequent decades, this episode offers insights into recurring patterns of crisis management. The mid-20th century saw the full abandonment of gold convertibility in 1971 under Nixon, further entrenching fiat systems prone to expansionary policies. More recently, the 2008 financial meltdown prompted massive infusions of public funds to avert institutional failures, mirroring the 1930s prioritization of systemic preservation over individual equities. In Cyprus during 2013, depositors faced direct levies on accounts to recapitalize banks, evoking parallels to asset seizures. The 2020 global health emergency accelerated monetary creation, inflating assets while compressing real wages, a subtle erosion akin to historical devaluations. Inflation, in this vein, functions as an insidious mechanism of wealth reallocation, diminishing savings worth without overt confiscation. Over generations, it underscores the fragility of monetary rules, which governments may alter to navigate pressures, whether from wars, pandemics, or recessions. This history encourages diversification beyond conventional holdings, cultivating expertise in trades immune to policy whims, acquiring tangible commodities with intrinsic utility, and studying past precedents to anticipate shifts. Ultimately, the 1933 gold policies exemplify how economic imperatives can redefine property norms, framed as essential for national resilience. They remind us that financial sovereignty demands vigilance, informed by the interplay of power and money across time. As societies evolve, understanding these dynamics equips individuals to navigate uncertainties, fostering resilience in an ever-changing landscape.